So now that you're a successful business owner, let's talk about KPIs. What is the big fuss? Firstly, what are the KPIs? KPIs, simply put, is key performance indicators. They are a measure of success of your business. They also help you to stay in track to help you reach your goals. However, as many goals as there are, if you Google KPIs, there is hundreds of lists listing different things that you should be measuring in your business. Very quickly, it can become quite overwhelming and confusing. So what are the best financial metrics that you should be measuring in your business? Firstly, and it's probably the most obvious one, is the net cash flow. You want to ensure that your business, at least majority of the time, is cash flow positive. What does that mean? That means that after your customers pay you money and you spend money on your business overheads and outgoings, there should still be money left in the bank. That would indicate that your business is cash flow positive. The second one is monitoring your gross profit margins. Your gross profit margins is your sales less the cost of goods and services sold. It is most critical for industries that have stock on hand. However, it's equally important to the services industry. The gross profit margins indicate how much it's actually costing you to produce that good or that service, the product or that service, for you to generate a sale. Low gross profit margins can indicate problem with your pricing. Maybe you're not pricing your products correctly. They could also indicate problems with your supply chain, and that might require looking at your supply chain agreements and seeing what you can do to reduce that cost. The third financial matrix that you should be looking at is your net profit margins. Now, this can become a little bit confusing depending if you're producing your reports on the accrual or on the cash basis. If you're a small to medium-sized business owner, I would say to make sure that you set your reporting system to the cash basis and you review that. Your net profit margins is effectively the profits that your business is making before your interest and taxes, but after all of your overheads for the business. A good rule of thumb is to aim at 20 to 30% net profit margins, but of course it will depend on different industries and where are you at in terms of your business and or product and service cycle. Another important KPI to keep an eye on as a business owner is to look at the days in accounts receivable. So how long does it take your average customer to pay you? That doesn't necessarily mean it will be aligned with the same system as your payment terms. For example, your payment terms could be 14 days from the date of invoice, but if you look at the days in accounts receivable, you might actually learn that it takes your customers 30 or 45 days on average before you collect the payment. It's important to know and understand that so you can effectively manage your cash flow. If you hold stock on hand, if you're selling products as opposed to services, the other KPI that might be worthwhile keeping an eye on is the inventory turnover rate. It will help you to identify which products are the ones moving out of door quickly and what might be sitting as an obsolete stock flagged for you to further manage. The above listed KPIs are predominantly focused on the financial aspect of your business, and they can help you to measure the financial health of your company. Of course, apart from measuring your business in financial terms, it's also important to look at the other KPIs within your business. Some of other KPIs that you want to be tracking for your business is your customer KPIs. So things around the cost of acquiring a new customer might be an important one for you, as well as an average retention tracking. We all know that it's a lot easier to generate more sales from existing customers than it is to bring new customers into your business. If you're a bigger size employer with 10 or more employees, I would also recommend looking at your operation KPI and your staffing turnover. A business that has a high employee staff turnover spends a lot more money on training new employees and on the cost of recruitment. It also means that there's a lot of knowledge that walks out the door. You may also want to understand, if you have a high staff turnover, what causes it. One of those things that you might want to keep a track of is then looking at exit interviews. It's also important whenever you spend money on your business growth to understand what isn't working for you. One of such metrics would be looking at your marketing ROI, which is return on investment. That means tracking your different marketing campaigns and looking at how profitable those campaigns are in order to determine whether you should be pursuing the same way of marketing and promoting your business or whether you should try something different. Whilst it might seem like there is a lot of different KPIs that you should track, not all of them will apply for you and your business. For example, if you're not hiring employees, or if your only employees are family members, or if your only employees are long-term staff, then you don't have to track your employee turnover. On the other hand, if you're not spending any money on marketing and the only way that your business is growing through a word of mouth, you already know that you're not spending any money. There's nothing further for you to track. The same goes with the services versus the product industry. If you don't sell any products, if you're a service-based business, then of course you don't have to track your inventory turnover and worry about obsolete stock. The few that you do want to stay across though, regardless of the industry that you're in or the size of your business, is looking at your net cash flow, which is the cash at bank after you pay your bills, your gross profit margins, your net profit margins, and the average days in accounts receivable. That's regardless of whether you're in product or service, or the size of the business, or how many staff you employ, or if you employ any staff at all. This will give you a very good health check for your business and will help you to understand whether it's time for you to seek financial experts' advice.